Good morning and welcome to Stock Market Today. It's Wednesday, May 27th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today, where you can sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So U.S. equities finished higher in Tuesday's trading, with the S&P 500 trading above the 3,000 level and its 200-day moving average for the first time since early March before selling off late in the day. Cyclical sectors outperformed while growth lagged. Treasuries were weaker, led by the longer maturities. The dollar was lower on the major crosses. Gold finished down 1.7%. WTI crude settled up 3.3%, continuing strength. As we get to the desk this morning, futures are up about 1.3%, near the best levels of the day. Asian markets were mixed overnight, with Japan, Taiwan, and South Korea leading, while China and Australia lagged. European stocks are trading higher. Treasuries are flat, and the dollar is stronger against the yen, but weaker once again against the euro. Gold is down 40 basis points. WTI crude is off 0.5%. And there it is, folks. There's the line in the sand. The 200-day moving average near 3,000. Key resistance near 3,000. Market tried to push through yesterday and then faded throughout the afternoon. So with futures trading higher this morning, we have to ask, if at first you don't succeed, try it again. Now, what I think is likely is, should that resistance level near 3,000 break, you got to start thinking about 3110 to the upside, brings you into this area here of the initial reflex rally from the sell-off. Also lines up with the 76.4% retracement of this entire move down. It's a lesser known of the retracement levels, but still one that does come into play. On the downside, initial support remains 2,800 to 2,850, 2,750 below that kind of lines up near the now rising 50-day moving average. We're near overbought levels when looking at the 13-period CCI and its 3-day moving average, and Chaikin money flow is kind of flat to bearish. So the battle continues to wage in and around this 3,000 mark for the S&P 500. And as that battle wages, we are seeing some early signs of rotation under the hood, right? Go back to the show last Tuesday, go back to the show yesterday. And recall, we started talking about rotation into some of the more cyclical areas of the market. We're keeping an eye on those levels and watching that rotation very closely here, especially given that it signals broader participation in the equity rally should it continue. So our market in a minute, what are we writing about today? Well, SPY fails to hold the 300 mark after a late day fade. IWM, that's the small caps, continue to see slight improvements in relative strength. Options market sentiment begins to become complacent, while speculators remain largely net short. Futures, as I said, do point to a higher open here today. Now, the major indices from a power bar perspective, the Dow added 2.23%. There's your kind of cyclical rotation. 4 bulls to 9 bears there. S&P 500 up 1.3% on the day, 77 to 134, still in favor of the bears. NASDAQ down on the day. 32 bulls to 14 bears there, as that group has seen some near-term underperformance. Small caps, again, we've started to talk about the improving relative strength. They outperformed yesterday, 517 to 280 bulls to bears. Bonds downtick, sending yields higher. Financials, one of those kind of beaten down value cyclical areas of the market, where your big outperformer yesterday at the sector level, up over 5%. 4 bulls to 14 bears there. So according to the Chaikin Power Bar, small cap stocks are more bullish than large cap stocks, and the major markets across the board are mixed. Let's hit our stock of the day now. Remember yesterday, and even in last Tuesday's show, we talked about fading relative strength in healthcare. Now we're starting to see some signs of that picking up a little bit in the near term. So with that in mind, we started to drill down on the XLV to see if there were any bearish stocks that might be setting up as an opportunity to the bearish side of the portfolio, or if it's a name that's in the portfolio, you might want to consider why you own it. And CERN fits the bill. Bearish rating here. Trend is weak as it's below the trend line. Now, the industry group is still strong as healthcare tech has a bullish power bar ratio. But as I look at Cerner here, I'm seeing early signs of what we call a personality change. Personality change takes place when a stock goes from being an outperformer to being an underperformer, as happened in early May for Cerner. And then shortly thereafter, the rating turns bearish. Now the stock is overbought based on our indicator, just getting into overbought conditions, and shaken money flow is bearish as the stock trades below that declining long-term trend line. So this to me is a compelling opportunity on the bearish side of the portfolio if, in fact, this rotation continues to play out and investors rotate out of some of the leaders such as healthcare and into some of the more beaten down cyclical areas of the market, such as financials, materials, which we've talked about, even energy at this point. So Cerner looks like an interesting setup on the bearish side of the portfolio here. If you're looking for some ideas like that, is our stock of the day that we are highlighting in our note for Chaikin Analytics clients today. Moving now to the sector tracker, and you can see a little bit more of that cyclical rotation in the near term that we've been talking about. Financials at the top of the list, 6.8% to the good over the past 5 days. Industrials, energy, materials, all in the top 5 of sectors that are up and kind of outperforming over the past 5 days of trading. Real estate also in the mix. It's been one of the beaten down areas of the market. That's potentially on positive sentiment around reopening. Discretionary comms and utilities are middle of the road, and some money rotating out of technology perhaps. And staples have come under near-term relative pressure, and healthcare, we've talked about it for the past 2 weeks on this show, is the only group that's lower over the past 5 days of trading. So now our industry in focus, transportation services, which over the past 6 months has been a laggard, right? It's underperformed the S&P 500 by nearly 18%. It has a weak power bar ratio with 7 bullish stocks and 11 bearish stocks. It's currently ranked in the bottom third, number 14 of 21 subsectors that we track. So some of the indicative names there: UPS, United Parcel Service, very bearish. Kirby Corporation, KEX, very bearish. And Hawaiian Holdings, HA, also with a very bearish rating. So this is kind of an interesting spot here for XTN. Bearish rating, but the trend has turned strong as the stock rallied above, as the fund rallied above the long-term trend line. Now it's overbought with bullish money flow, continues to be an underperformer, but the intensity of underperformance has been diminishing around hopes of reopening. You can take a look at some of the airline stocks that have performed better over the course of the past couple of weeks as those reopening hopes have permeated throughout the marketplace. For me, not a ton here to get excited about just yet. I am watching, though, as I am watching all of these sectors that have become beaten down, as they are seeing some near-term outperformance. And by near-term, I mean over the course of the past week or two. We've been talking about the cyclical rotation. Whether it gains legs is something that we'll have to keep watching. But we are mindful of the potential rotation at play. Right now, too early to tell whether it's just a reflex counter-trend rally or something bigger. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers, right? Kind of gets back, a lot of it gets back on the gainer side of the board to the rotation / reopening. ADS has been a name that's been beaten down. No real news, but the stock up 17.5% yesterday. United Airlines, UBS, was out with a new report looking at price trends for the industry, and it looked to be that price trends were starting to stabilize in the May-June timeframe for United. Also lump this one in with the reopening basket, if you will, and United is up 16.3% yesterday. Another reopening name, bearish, Norwegian Cruise Line, up 14%. Royal Caribbean, reopening name, up 14.88%. United and American Airlines up 14.8%. Now, all three of those stocks still have bearish ratings here at Chaikin Analytics, but deeply sold off. A little bit of a reflex rebound here on reopening hopes. Now, the loser side of the board are some of the names that are being seen as sources of capital or profit taking here in the near term. Take-Two. There were actually positive analyst comments around Take-Two, but the stock was down 7.3%. Now, if there's a reopening, right, Take-Two is one of the groups that, one of the stocks, along with Activision at the bottom of the list, that benefited from the stay-at-home trends. If we're starting to see a reopening, it makes sense that money would rotate out of those stocks. Vertex, nothing company specific there. It's been part of that healthcare group, right? Healthcare starting to come under pressure. Names like Vertex, which we've liked, could be ripe for some profit taking. Newmont under pressure yesterday with the gold miners. If you look at GDX was down nearly 4% at one point in the day yesterday. Newmont down 6%. Regeneron, there is a large holder who is selling stock. That stock down 4.3%, but again, part of the healthcare group. And Activision Blizzard, lumped that in with Take-Two, nothing company specific, driving that stock down by 4.2% on the day yesterday. So taking a look at sentiment as well as positioning. Now, sentiment, based on the options market, has moved into the area of excess greed, right? We're down here at 0.55% on the CBOE equity put call ratio. And when we get below 6, that tends to be signs of near-term complacency in the market. Now, we got down to about 0.5 or so back when the market topped out in January and February, and then extreme fear pushed us hard in the other direction. Now, as the market has rallied, the options market has become more complacent. So now it's kind of interesting with the S&P 500 dancing with that 3,000 mark, dancing with the 200-day moving average, a key level. Sentiment has become complacent. I think that means you really want to watch that level closely. A break obviously targets more upside, as we've said. But I think it makes sense to wait for the break. At the same time, large and small speculators remain net short. Taking a look at the bottom of the screen, right? Speculators were largely net short. If you look at the 52-week Z-score at the lows, and now they've come off those extreme levels a bit, but still largely net short, still down here around some of the lows that you've seen over the past, call it 5 years. So as the markets rallied, the shorts haven't covered. Now, one of the things that I'm starting to think about is perhaps these investors are using the index products like the S&P 500 as a hedge, right? So short the index while being long the stocks that you like. That could be one of the potential ways of looking at this. Always hard to tell with this kind of data, but that is one of the areas that I'm thinking about. However, a break of 3,000 and that 200-day moving average likely could lead to some capitulation on the part of the shorts, which would drive the S&P 500 to the next stop on the roadmap that we've laid out, up around 3110 for the index, call it 311 for the SPY. So, sentiment and positioning, painting two kind of different pictures at the moment. So we'll continue to watch price to see who the market deems as the winner. Now, small caps continue to improve. We've been talking about this a little bit of late. So here's now IWM has rallied back into this resistance zone between 135 and call it 141, 142 to the upside, still below the 200-day moving average, but above the rising 50-day moving average as the RSI attempts to shift into bullish ranges. All right, so that's a positive signal here for IWM, also a positive signal for the market to the extent that it continues to play out as it points again to a broadening of participation in the market's rally. So for me, though, we're watching the relative strength closely, which is again broken topside through the resistance zone when we look at the bottom of the chart at IWM relative to the SPY. So some potential shifts at play, still early in the game in terms of those shifts, but something we want to be paying attention to, right? Because if these shifts continue, you have to start thinking about the leading areas of the market like growth, tech, healthcare, starting to come under potential pressure as money rotates into those more cyclical areas, more value areas of the market. And that would have an implication for rates. As I think if that rotation continued, you would expect to see a sell-off in treasuries. What's interesting is you're not seeing a sell-off in treasuries and a spike in yields yet, right? Yields spiked down hard on the sell-off, rallied back, and now they've settled into this range below the 50-day, below the 200-day as the RSI settles or continues to trade in bearish ranges. So the fixed income market, while stalling, not sending the same bullish signal as the equity market. So something we'll be watching closely. That's going to wrap us up for today. Take us for a test drive. I'll be back tomorrow.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.